Gordon has had the following financial results for the last 4 years. So we have sales, we have cost of goods sold, we have gross profit, and we have inflation factor for year 1, for year 2, year 3, and year 4. Gordon has analyzed these results using vertical. Gordon has analyzed these results using vertical common size analysis to determine trends. So they are using vertical common size analysis to determine the trends. The performance of Gordon can be best characterized by which one of the following statements. So they are using the vertical common size financial statements. In vertical, what happens for income statement? For income statement, we use sales as the base, and for balance sheet we use total assets as the base. So the calculation, the formula to calculate or to convert these into vertical common size analysis is amount of the line item, by amount of the base. So this one is the income statement. So the base amount will be the sales. Sales will be the base amount. So let us convert these item into vertical common size analysis. So cost of goods sold will be 750,000 by 1.250, that cost of goods sold by sales, which gives you 60%, and 785,000 by 1.3, so 1 million, 1.3 million, that gives you 60.3%, and 825 by 1.359,000, which gives you 60.7%, and 850,000 by 1.4, which is 1 million, 1,400,000, which gives you 60.7. Now gross profit 500,000 by 1.250, which gives you this gross profit by sales is 40%. Gross profit by sales in year 2 is 39.6%, and gross profit in year 3 is 39.2%, and gross profit in year 4 is 39.2%. That is amount of the line item divided by the amount of base. The amount of base is sales, and that is gross profit is the line item, so that is 550,000 by 1.4 by sales, so you get 39.2. So here what happens, your cost of goods sold is increasing. Here the cost of goods sold is increasing and the gross profit is decreasing. It's 40%, it has come down to 39.6%, then it has come to 39.2%, then 39.2%. But here 60 point, from 60 it has gone up by 60.3, then it went to 60.7, and so it's increasing and this is decreasing. So the correct option for this MCQ is that the common size gross profit percentage has decreased. The common size gross profit percentage, which is this, the common size gross profit percentage has decreased as a result of increasing common size trend in cost of goods sold. The trend in cost of goods sold has been increasing. So this is the correct option. Next. Shown below are the components of company's financial statements. We have sales revenue, we have cost of goods sold, we have total assets, we have total equity and net income. What percentage value would net income be on common size financial statement? So this is the income statement. So for income statement, sales is the base, and the formula that is being used is amount of the line item by amount of the base. So the base amount for income statement is sales. So base amount will be 600,000, and they're asking for net income. So net income is 120,000. So 120,000 by 600,000 will give you a percentage of 20%, which is the option C. Next, a financial analyst is reviewing a competitor's income statement for the past 2 years. So we have sales, we have cost of goods sold, we have gross profit, we have selling expenses, we have general expenses, we have operating income before income taxes and taxes related to operations, net income, and financial analyst able to conclude that the competitor. So here we have vertical analysis as well as horizontal analysis. So the option A and B is vertical analysis, and option C and D is horizontal analysis. So let us see. Common size, this is income statement. So for vertical analysis, sales will be the base. Sales is the base. So the common size income statement will show a operating income before taxes is 22%. So operating income before income taxes. So operating income before income taxes in year 2, it is 25,000. And what's percentage of its 275,000? So it's 25,000 amount of the line item divided by the amount of the base. So the amount of the base is 275,000, 25,000 by 275,000. So that is equal to 9%. So this is not 22%, this is basically 9%. And this is option A. So let us now calculate for option B. Common size income statement will show taxes related to operations. So they are asking for taxes related to operation in year 2, what's percentage of net sales. So it is 3,500 amount of the line item divided by the amount of base. The amount of base is 225,000. And this comes to be 1.27 percentage. So this is not 16%, this is not 16%, it is 1.27%. Now see there's common base here. So year 1 is the base year, and year 2 is the current year. Now for option C, it is here we have to calculate the percentage change. So how to calculate percentage change? So percentage change is calculated by percentage change is equal to change by original into 100. That is change by original into 100. So for C, so they are asking for gross profit. So gross profit, what is the change? So gross profit, let us see, this is the gross profit. They are asking for gross profit. So it's 115,000 minus 95,000 by the base, by the original, that is 95,000 into 100, which comes to 21%. So it's not 17%, it is 21%. Now next, D. So the option D is they are asking for selling expenses. So selling expenses, we have here selling expenses. So selling expenses is 40,000 minus 35,000 by the original, change by the original. The original is 35,000, and into 100, which gives you 14%, which D is the correct option. Next, a company's financial statements for the past 2 years have the following values. So we have sales revenues, net income, total assets, and inventory, previous year and the current year. So let us know what they are asking for. Using horizontal analysis, what account has the largest percentage change? So they are using the horizontal analysis and they are asking for the largest percentage change. So first we need to find the change. So what is change between the previous year and the current year? So for sales revenue, there is a change of 600,000, that is 6 million and 6.6 million. The change is 600,000. And for the net income, the change is 40,000. And for the total assets, the change is 500,000. And for inventory, previous year it was 600,000 and the current year has been 500,000. So there has been a negative change, that is minus 100,000. So now let us find the percentage change. So percentage change is equal to change by original into 100. Now for sales revenue, it will be 600,000 is the change and the original amount is 6 million. That comes to be 10%. So there has been an increase of 10% in sales revenue. So now we have net income. Let us see what happens to net income. So net income, the change is 40,000 by 500,000. So the change comes to be 8%. So there has been an 8% increase in net income. Now we have total assets. So the total assets, the change in total assets is 500,000 by 10 million into 100. That the change comes to be 5%. So there has been a 5% increase in total assets. Now we have left with inventory. So inventory is minus 100,000 by 600,000 into 100. So that is minus 16.6% decrease. So they are asking for largest percentage change. So largest percentage change is 16.6%, which is downwards. So it's for sales revenue there was a 10% increase, and for net income it was 8% increase, and for total assets we have 5% increase, but for inventory we have 16.6% decrease. So this is the largest percentage change, that is inventory. This is the correct option.